If you're thinking about buying your next home, but not sure whether you should sell your current one or keep it as a rental, you're not alone. This is one of the most common scenarios I work through with move-up buyers here in Washington State. And the good news is that it's absolutely doable, but the rules are more nuanced than most people expect, and they're significantly depending on which loan program you're using for the home that you're buying. So let's walk through it. Here's the fundamental issue that your lender has to work through. When you buy a new home while keeping your existing one, you're now qualifying for two mortgage payments simultaneously. Even if you plan to rent out your current home, that rental income may or may not be able to be used for qualifying depending on your loan program and if you have a signed lease in hand. So that's why it's important to talk to your loan officer before you start house hunting. The decision to keep or sell can dramatically change how much home you can qualify for with your next home purchase. Fannie Mae and Freddie Mac offer the most flexibility here. If you have a signed lease in place for at least 12 months, you can use the rental income to offset the existing mortgage payment. Without that signed lease, that full payment counts against your debt to income ratio. You'll also need reserves for each finance property. FHA is actually more restrictive for this scenario than most people expect. To use rental income from your departing home, FHA requires you to be relocating due to employment, and the new home needs to be more than 100 miles away. There's also a 25% equity requirement in the property that you're converting. So if you're buying locally, FHA generally isn't the right fit for your situation. VA loans, and this surprises a lot of veterans, actually do allow you to keep your current home as a rental and use the remaining VA entitlement to buy your next primary residence. It's called a bonus entitlement. The amount of the entitlement is available based on the county loan limit where you're buying, minus whatever entitlement is already tied up in the departing home. Depending on how much entitlement remains, you may or may not need a down payment. If you're a veteran in this situation, it's definitely worth a conversation. USDA is one program that doesn't work here at all. USDA only allows borrowers to own one property, so retaining your current home makes it ineligible. Something to be aware of is that to use rental income under conventional guidelines, you will need the signed lease, but a lot of buyers haven't found a tenant yet when they're applying for their new mortgage. And so if you're in that situation, the full departure property payment will count as a liability and be factored into your debt to income ratios. Depending on your income and the size of that payment, it may or may not affect your qualifying position for your new home, but it's something that we do need to plan around and discuss. It's also worth knowing that lenders are going to discount the amount of gross rent for qualifying purposes on your departing residence, even if you do get a signed lease. And that's going to account towards vacancy and maintenance towards the rental property. This is a financial and lifestyle decision, but a few things worth thinking through is, can you comfortably qualify for the new home while carrying the existing mortgage? Will the rent actually cover the full payment, including property taxes and homeowners insurance and future adjustments with the property taxes? Do you want to be a landlord? And have you considered a bridge loan to access your equity before deciding whether to sell or retain your current home? There is no right answer. It really depends on your specific equity position, your income, and your long-term financial goals. If you're a Washington State homeowner thinking about buying your next home and keep turning your current home into a rental property, I'd love to help walk you through the numbers. Every situation is different, and getting to the right structure from start to finish can make a real difference. You can reach me through mortgageporter.com, and there's also a full written guide on this topic on my blog with a program-to-program breakdown and a comparison table for you to reference. I'm Rhonda Porter, mortgage advisor in the greater Seattle area. Thanks for watching, and I hope to see you soon. Take care. Bye-bye.